We had a show about the recession earlier this week. It was on Tuesday. Not that we know exactly when it's coming, but most experts agree a recession might hit early next year. So we had sat down with a financial counselor, Jessica Moorhouse, and spent most of the program going through how to financially prepare for a recession. Now, if you missed it, you should just go back and watch it right now. But if you did watch it, let us refresh your memory with some of what she had to say.
It's just about being intentional with where your money's going. If it's hindering you from reaching your goals, where else can we look in your budget to cut back so you can reach that goal? You need to have a plan, and no one likes the term budget, so you can give it whatever name you want. So you need to track where the money is going to be able to identify the problem areas. You got to attack it head on, and you've got to take a look at everything that's, what are all the different debts, categorize and be like, okay, what are the interest rates? What are the balances? And then figure out what's the best strategy for me. Even before paying off debt aggressively, have an emergency fund. So the best thing you can do is to have some cash in the bank for when something happens, because it always will.
So that was just a sliver of our conversation. But at the very end, she said something that I wasn't quite expecting about making bigger moves with your money and mixing it up on the stock market.
Yes, there is risk, but it's not just it's all risky. It's like, well, it depends on where your money's going and what kind of risk are you taking. There's risk inherent in every form of investing in the stock market and the bond market, but you can be calculated about it. And there's lots of ways to mitigate that risk. This can be a great time to actually get investing.
Yeah, investing in this economy. Like, come on, right? But maybe it makes sense. And it's certainly worth a follow-up question or two, or 3, or 4, enough that we couldn't fit them into the last episode. So today, part 2 of my conversation with Jessica, and why investing right smack in the middle of what feels like the worst time not to have access to your money may actually be the best time. How can we be entering such uncertain times where inflation's sort of out of control and people are struggling to make ends meet, and you're saying that those very same RSPs that I've got a little bit of money tucked away into that are tanking right now, and I'm watching them tank in real time, that now is the time to
put more money in. You're like, why would I put money into a loser? Doesn't make any sense. Okay, the stock market, the bond market goes up and down. I think the biggest thing that I can share with people is don't focus so much on a short time frame. You need to zoom out and take a look at what's happened the past several decades.
Let's talk about that, because it's a critical point about the stock market. If we take the S&P 500, which tracks 500 large companies in the United States, and if we only look at the last year, well, it looks pretty disastrous, right? Down 25%. But let's look at the 5-year, and all of a sudden, okay, we've seen crashes before, and end to end, we're not down anymore. Now, let's look at the 10-year. Okay, we're starting to get a sense of perspective, right? And the 20-year, it's even clearer that these huge crashes happen. But if you give it enough time, markets bounce back. Happens every time. Okay, back to Jessica.
You need to actually invest when things are bad. That's how you take those opportunities, but you've got to be strategic. You understand what you're investing in. I'm not saying just buy this individual stock because it's down. It may not be a good investment, but you need to be really methodical and you got to be patient. But it's hard to think that forward. It's so hard, especially when you're younger. You're like, I can't think past next year. But how you build wealth is staying invested consistently, being boring and simple about it for decades.
Okay, so here's the other thing about investing, that I liken it to, it's like you walk into a casino for the first time ever, and you don't know how any of the games work. And my first question is, what game do I play? What do I invest in?
So I know a lot of young people, especially got so many messages in 2020 and 2021 about picking some hot stocks, like Tesla was all the rage. cryptocurrency, NFTs. And I'm like, oh my gosh, if you're just starting out, that is not where you start, because those are very risky and you should really know what you're doing and you can lose some money. One, key principle of smart investing is making sure you don't put all of your eggs in one basket. And so that's why investing in a fund where you're investing in hundreds, if not thousands of companies, you're spreading your money around in lots of different baskets, that's a great way to start investing.
Because when you say fund, what do you mean?
Yeah, it's like a basket of securities.
A security, by the way, is just a financial asset that you can trade on the open market, like a stock or a bond. We'll get into that in just a little bit.
But there's lots of different ones. There's mutual funds. There's also exchange-traded funds, segregated funds, closed funds. There's lots of different funds.
Okay, me again. If your brain just exploded, that's okay. Let's get you cleaned up, and then let's explain what we're talking about here. So a fund, like Jessica said, it's just a bunch of stuff. It could be a bunch of stocks, a bunch of bonds, or maybe even a mixture of the two. A mutual fund is a bunch of stuff that you buy into with other people. So you all pool your money. A professional money manager then takes all of that money, charges you a fee, and then picks a mix of securities that you all invest in together. An exchange-traded fund, that's another big one that she mentioned. So an exchange-traded fund, an ETF, is just something that you can buy and sell. It's a fund that you buy and sell yourself, so on an exchange, on a market. So it's like buying stock, except you're buying a bundle of them, and often these are heavily diversified, sometimes with hundreds or even thousands of products inside. What's more, both mutual funds and ETFs can be what are called index funds. So you've heard about how sometimes a person's salary can be indexed to inflation, which just means that the salary rises along with inflation. Well, you can buy index funds, which are bunches of stocks and bonds that are indexed to a particular market. So for example, one of the oldest exchange-traded funds, ETFs, out there is called the SPDR. It's an index fund that tracks the S&P 500. So all it's trying to do is to match the ups and downs of the market as a whole. And these are generally considered pretty solid, pretty boring, but pretty productive places to put your money, because over a long enough period of time, markets as a whole tend to go in just one direction. And in theory, I guess, if the index fund is tracking the general trajectory of whatever fund it's indexed to, or whatever thing it's indexed to, what you said earlier is really important here, that the markets always go up.
Exactly.
And so you're just
that's kind of
money.
one of the benefits, I think, of index investing, besides also typically they're just easy to invest in. They have much lower fees, which is more money in your pocket. Lots of those active managed funds, or even those strategies where you're buying and selling your own securities, very high fees. This is very easy, low fee, and yes, when the market goes down, your fund is going to go down. When it goes back up, your fund is going to go up.
Is this where what you were saying earlier, boring is good?
Yeah.
This is
Simple
where
and
this
boring
comes
can be a great way to invest. But a lot of people, when they think of investing, like you gave the analogy of the casino, they think of it as a casino, they think of it as a game, they think they need to find all these opportunities, and it can be exciting. And but I don't like investing as if it's gambling. I want to invest so I can make sure I have enough money to reach my goals, to retire one day, to maybe have a cottage one day, I don't know. But I want to make sure I'm going to hit those things, and I'm, going to possibly sacrifice over and above returns that maybe an active strategy can get, because I want something consistent and steady, and I know how it works. I know what I need to do as an investor, which is continue to invest for the long term, not freak out, not cash out when the market's down, just keep going.
How do you do all this, by the way? So I decide, okay, index funds sound great.
Yeah.
Find something with low fees, right, as you were mentioning.
Yeah.
Where do I go? Where do I buy that?
Yeah. So there's kind of three routes you can go for investing in general. You can work with a professional who manages your portfolio, and you can do that with indexing. There are managers that do that. You can use a robo-advisor. There's lots of ones in Canada now, I think maybe 9 or 10 or something like that. They have these pre-built portfolios of index exchange traded funds. So they have this portfolios built. You do an online questionnaire so they can determine all these factors, what's the best portfolio for you, then you start investing, and it's very easy, set it up online, you can do auto contributions or what have you, and they manage it for you. Or you can do what's called calls self-directed investing, or sometimes it's called do-it-yourself, DIY investing. You open up a discount brokerage account, and then you can do whatever you want. You can buy individual stocks, buy individual bonds, you can buy a fund, you can do whatever the heck you want.
And so in all of these cases, you can either go through like your bank, for example, or like, I mean, you see those ads for like Questrade and Wealthsimple and all that kind of stuff.
So Questrade is an example of a discount brokerage.
Right.
So why that could be good if you're like, yeah, I want to do it on my own, great. Easy to set up, you do it on your own. They don't provide any advice. You're your own investment professional, you're the driver of that car. But if you do want someone to manage it, to give you advice, that's where you'd want to hire a professional. And then you can also hire a fee-only or advice-only financial planner who can give you that advice, but they're not managing your investments. And I kind of like that kind of mixture because they're a little less biased because they're not selling you something besides their advice.
Right. Speaking of advice, this advice that you're giving must change depending on the person and what they're actually trying to accomplish, right?
Because everyone's different, everyone's circumstances is different, and when it comes to personal finance, there's no such thing as like one size fits all. So if you have a low risk tolerance, you don't want to take on too much risk, you don't like seeing too much volatility, then you're going to want to have a bigger portion of fixed income in your portfolio than equities.
Okay, fixed income investments versus equities. What is she talking about now? Well, when we talk about investing, equities are just stocks, so shares in a company, which rise and fall depending on how well the company does. And there's risk, because if the company tanks, so do your stocks. But when we talk about fixed income investments, we're trying to eliminate risk by investing in things that give a predetermined steady rate of return. So bonds, which are just basically loans, are an example of that. If you buy a government bond, you're loaning them money, and when payment is due, they give it back, plus interest. The downside is that you're not going to get rich off bonds. You sacrifice profits for stability.
And so bonds in general kind of cushion the volatility. So if you have like a 100% stock portfolio, it is going to be up and down. If you have 70% stocks and 30%, bonds, it's going to be not as bad. But you're also potentially sacrificing higher returns. So in general, if you don't have as long of a timeline, you may not want to take on as much risk because you're like, well, I need this money to live off of. So I don't want to be 65 with an all equity portfolio and, well, we're in a down market. And if I were to withdraw money now, well, my portfolio is down 30%. So
like the timing is all wrong.
The timing's wrong.
Yeah.
So you always want to adjust kind of the riskiness and that balance of stocks and bonds to portfolio depending on what your timeline is. And so when you were talking about a young person, even though it may sound kind of crazy, you can actually be in a 100% stock portfolio. And the reason is you have decades to ride out those ups and downs.
So with bonds, less potential to make a lot of money, but safer.
A little bit safer. They do provide, a cushion for volatility. They provide income through interest, but you're not going to earn. Like if you're in a 100% bond portfolio, you may not be able to actually retire off that because it's too conservative, and you're not going to earn as much as you need. You want something to not just beat inflation, but to earn over and above so you can reach your goals in the future.
So when I started by asking you, what should I invest in? That was the wrong question. That's what you're telling me.
Maybe, but that's what everyone asks, so I don't mind.
It is a roller coaster, though.
It sure is.
Like emotionally, right?
Which is why one of my best tips is to, especially if you're investing long term, don't look at your investments that often. Like you don't need to. They're doing their thing. It's not going to help anybody if you take a look every second on your app. You're just going to feel anxious. And so, especially during this volatile time, like for me, I invest, I think, money monthly. And then I do a little assessment in my little net worth sheet, type in what I've got in there, and then I don't look. Because it just makes me anxious. So this one saying where like investing is like a bar of soap, the more you touch it, the smaller it gets. Because people feel like they need to do something, they need to touch it and do something. Maybe if I just move this over here and sell this and buy this, it's like then you're not doing the plan that you set out. You're mucking it up. So the best thing you can do is create that plan, implement it, stick with it, don't touch it.
Jessica, can I put you on like speed dial just if I have another question?
Yeah, all right, that's fine. You can text me whenever you have a question.
Thank you so much.
Thanks.
So, hey, I hope you found that helpful. And you know, I'm sure we'll have Jessica back on the program to talk about all kinds of financial topics. And let us know if there are sort of big, scary things that you want us to dive into and maybe make a little bit more approachable. We're always happy to hear from you.